Imagine you were handed a corporate checkbook, right? And you were given this singular, terrifying mandate. You need to spend $725 billion this year.
Good luck with that.
Right. And you're not buying a country.
Yeah.
You aren't, funding a global space program to colonize Mars. You are Amazon, Microsoft, Google, and Meta. And you're collectively spending that mind-boggling amount of money purely on AI Capex, capital expenditure, just in the year 2026.
Yeah, it's just wild.
Just to put the sheer velocity of this in perspective for you listening, that is a massive 77% jump from the $410 billion they spent just a year ago in 2025.
It's a staggering acceleration of capital. I mean, the context for our conversation today it's really critical. Today is July 1st, 2026, and the global market is currently reeling from a massive shockwave that is directly tied to the consequences of that exact spending spree.
Yeah, and in today's deep dive, we are pulling from a massive stack of sources. We've got fresh Bloomberg reports, Morgan Stanley financial models, leaked data center supply chain metrics, and we're using all of this to explore this unprecedented $725 billion AI arms race.
Exactly.
We're going to unpack why Meta, which is a company that doesn't even operate a public cloud, by the way, is somehow spending up to $145 billion of that total.
Which makes no sense on the surface.
Exactly. And most importantly, we have to analyze the breaking news from today that sent Meta's stock soaring 10%, while, absolutely crushing smaller AI infrastructure companies. Okay, let's unpack this. Spending $725 billion in a single 12-month window isn't just a corporate budget. That is like funding the entire GDP of a medium-sized European nation just to buy server racks and cooling systems and power cords.
Yeah. It really is.
Why are all four of these tech giants doing this at the exact same time?
So the simplest, most honest driver behind this is fear. Yeah, pure fear. Every single CEO at these hyperscalers fears being structurally short on computing power far, far more than they fear overspending on it.
Oh, wow.
It's a classic asymmetric risk profile,
Yeah.
right? I mean, if you overbuild, yes, you take a painful hit to your profit margins for a few quarters. But if you underbuild, you risk losing your dominance for the entire next decade of computing.
So it's existential for them.
Totally existential. And to give you a concrete example of this panic from our sources, Microsoft currently has an $80 billion Azure backlog that they literally cannot fulfill.
Wait, 80 billion?
$80 billion.
Yep.
They have enterprise customers waving checkbooks at them, begging for AI computing time. But Microsoft has to turn that revenue away because they are bound by severe physical constraints.
Hold on, $80 billion just sitting on the table because they can't plug in enough machines. That completely shifts how we have to look at this narrative. It takes us from questioning why they are spending this much money to desperately needing to look at what this money is actually buying.
Yeah.
Because if Microsoft can't just throw cash at the problem to fulfill that backlog, the bottleneck in the AI industry has fundamentally shifted since last year.
It has. And let's break down where that $725 billion is actually flowing, because it tells a fascinating story about physical bottlenecks.
Yeah.
So Amazon leads the pack at roughly $200 billion.
Just Amazon.
Just Amazon.
Yeah.
Microsoft is right behind them at about $190 billion, and Google is guiding for somewhere between $175 and $185 billion.
Okay, so if I have $200 billion in my pocket, what exactly is going into my shopping cart?
Right, so roughly 50% of that total goes directly to compute and silicon. We are talking over $260 billion going straight to NVIDIA for their massive GB200 and GB300 server racks.
NVIDIA must be thrilled.
Oh, absolutely. But the hyperscalers are also spending heavily, like over $80 billion on developing their own in-house custom silicon to try and break that NVIDIA monopoly.
Oh, right, like Google's TPUs and stuff.
Exactly. Google's TPU v6, Amazon's Trainium 2, Microsoft's Maya chips. Because controlling the silicon means controlling their own profit margins down the line.
I follow the logic there. The brains of the operation take half the budget. What happens to the other half?
Well, about 35% of the total, or $170 billion, goes purely into real estate and physical plant infrastructure.
Just the buildings.
Yeah, acquiring the land, pouring the concrete, building massive data center shells. And then another $85 billion goes strictly to networking and liquid cooling.
Liquid cooling.
Yeah, and we really need to pause on liquid cooling because these new AI chips run so incredibly hot that traditional data center air conditioning physically cannot remove the heat fast enough.
Like it would literally melt.
Basically, yeah. They're packing so much compute into such a tight space that they literally have to pump chilled liquid directly to the metal plates on the chips just to keep them from overheating.
Wow. Which brings us to the most shocking number in the breakdown. You have the land, you have the chilled water, but you still have to turn it all on. Our sources indicate that roughly 15%, or $105 billion, goes entirely to power generation and grid interconnects.
Exactly.
Yeah.
Chips are no longer the ultimate constraint in the AI race.
Yeah.
The constraint is the actual power grid.
That's insane.
We're operating at a scale that human infrastructure wasn't prepared for. I mean, a single new AI campus being built today can draw anywhere from 500 megawatts to over a full gigawatt of electricity.
A gigawatt.
Yeah, to put that in perspective for you, a gigawatt is the equivalent power draw of a mid-sized American city.
For one campus.
For one single campus. These tech giants are being forced to bypass the traditional grid entirely and sign massive power purchase agreements directly with nuclear power plants just to guarantee their lights stay on.
Okay, but I have to push back on the core economics of this, though. Look at this from a traditional business perspective. They are building literal nuclear-powered server cities. Are they actually going to make this money back?
That's the big question.
Right, because when a company spends $150 billion on hardware, that equipment isn't like real estate. It doesn't appreciate. Technology rots fast. These servers depreciate over roughly 5 to 6 years.
That is the elephant in the room, yeah.
So if I'm Google or Microsoft, I'm booking something like $17 to $20 billion in annual depreciation expenses on my balance sheet before I earn a single dime of profit back from that hardware. That crushes your free cash flow, the actual cash left over after paying for your capital investments.
Oh, completely.
If free cash flow is compressing this hard, this looks like a massive bubble. What happens if enterprise clients suddenly slow their roll? Won't these hyperscalers be left holding the bag? Like, how long is Wall Street realistically going to tolerate this?
What's fascinating here is that the divide you were pointing out is the single biggest debate in the financial markets right now. You've just outlined the bear case perfectly. The bears are terrified of that massive front-loaded depreciation. I mean, free cash flow compression is already highly visible in the quarterly earnings for Microsoft and Meta. The bear argument is that if enterprise AI adoption stalls even slightly, or if we hit a sudden air pocket in demand.
An air pocket?
Yeah, meaning startups run out of venture capital and just stop renting cloud space. If that happens, these hyperscalers are going to be left holding billions of dollars in stranded, rapidly aging capacity.
But the stocks are still largely holding up, so someone has to be buying this narrative. What is the bull case?
Well, the bulls look at those massive capital outlays and say, yes, it's expensive up front, but look at the revenue. The cloud AI run rates are growing at over 40% year over year.
Wow, 40%?
Yeah. And the bulls point out that these companies aren't just hoping for demand. They are actively locking in multi-year guaranteed enterprise contracts. Plus, that $80 billion they are spending on custom in-house silicon. That investment cuts their unit cost by 30 to 50% compared to buying off the shelf from NVIDIA. So the bulls see a guaranteed, highly defensible long-term payout.
Right. If these servers basically turn into expensive paperweights in 5 years, the only way to survive that math is to immediately rent them out to thousands of cloud customers to recoup the cost.
Exactly.
And that business model makes total sense for Amazon Web Services, Microsoft Azure, and Google Cloud. Which leads us to the most glaring anomaly in this entire deep dive, Meta.
Yep, Meta.
Meta does not have a public cloud. They cannot rent out GPU hours to Fortune 500 companies. Their spending is pure internal investment, which makes them the most heavily scrutinized player in this entire $725 billion arms race.
Meta is completely exposed here. For 2026, they originally guided for $115 to $135 billion in Capex, right? And on their Q1 call, they just raised that guidance to an astonishing $125 to $145 billion.
$145 billion for a company that cannot resell the hardware time. Where's the financial return actually coming from?
So it comes entirely from injecting that intelligence into their internal consumer products. They are using this massive compute infrastructure to train the Llama family of open source models and, crucially, to turbocharge their proprietary ad ranking algorithms.
Okay.
And you have to look at the data. It is working. On their April 29th Q1 call, CFO Susan Lee reported $56.3 billion in revenue, which is up 33% year over year.
That's huge. And our sources broke down exactly how they achieved that revenue jump. It's fascinating because it strips away all the, sci-fi AI hype and just shows the brutal business reality. Meta used their new AI infrastructure to double the length of the user interaction sequences their systems analyze.
Right.
So by feeding the AI twice as much data about your scrolling habits, they made the feed significantly more addictive. Reels watch time went up 10%, and global video watch time went up 8%.
And think about the scale of Meta. Keeping billions of users engaged for just a few extra seconds directly translates into billions of dollars in new ad inventory.
Exactly. The AI is literally paying for itself through human attention. They also caught a one-time $8 billion tax benefit, bringing their adjusted net income to around $18.7 billion. The core business is an absolute cash-printing machine right now.
It really is.
Huh?
And that cash engine funds Mark Zuckerberg's broader, incredibly expensive vision, which he calls personal superintelligence.
Personal superintelligence.
Yeah. While other tech CEOs talk about AI replacing human labor or, automating the enterprise, Zuckerberg is positioning Meta to empower the individual consumer. They just released their Muse Spark model, and they are rolling out the Ray-Ban Meta AI glasses.
Oh, yeah, the smart glasses.
Right, and the consumer traction is undeniable. Daily usage of those smart glasses just tripled year over year.
That's crazy. But here's where the narrative hits a brick wall. Despite spending up to $145 billion, Meta somehow ran out of compute.
Yeah, this is the crazy part.
Right. According to the supply chain sources, back in March, Google, who was supplying a portion of Meta's compute on a contract basis, actually cut Meta's allocation. Meta's internal training runs were hogging so many resources that Google had to pull the plug because Google desperately needed those servers for their own capacity constraints.
Yeah, that allocation cut put Meta in a desperate, highly vulnerable position. They had a mountain of cash, but you can't train an AI model on dollar bills, right? They couldn't get access to the actual computing power fast enough. So they were forced to pivot and turn to what the industry calls the Neoclouds.
Let's define that for the listener because it's a huge part of today's market chaos.
So Neoclouds are smaller, highly specialized cloud providers built from the ground up entirely around AI infrastructure.
Right.
They don't do traditional web hosting. They just rack up thousands of GPUs and rent them out.
Okay.
Meta was forced to sign massive contracts with these smaller players just to keep their development timelines intact. They signed a $21 billion deal with CoreWeave and a $27 billion deal with NBIS.
$27 billion.
Yeah, and the NBIS deal is particularly notable because it's specifically securing access to the new NVIDIA Vera Rubin platforms that won't even launch until 2027.
Okay, here's where it gets really interesting. I want to dig into the financial mechanics of those Neocloud deals because it explains so much of the risk in this market.
Oh, absolutely.
It's like a real estate developer trying to build a massive shopping mall. The developer doesn't have the cash, so they go to a massive anchor tenant like Walmart, or in this case, Meta. Meta signs a take-or-pay contract, essentially guaranteeing, we will pay you for this server capacity for the next 5 years no matter what.
Yep.
Then companies like CoreWeave and NBIS take that ironclad guaranteed contract to Wall Street banks, and they use it as collateral to issue massive debt.
It is highly leveraged financial engineering. NBIS just issued $8.3 billion in debt, and CoreWeave issued $6.25 billion, purely backed by these tech giant IOUs.
But if I'm looking at this objectively, isn't this an incredibly fragile house of cards for the Neoclouds? At the end of the day, their entire business model is just renting out raw computing power. It is an undifferentiated commodity.
Yeah, pretty much.
If the broader supply of servers ever catches up to the demand, or if Meta decides to break the lease, those Neoclouds are holding billions in debt they literally can't service.
Well, the vulnerability you just highlighted is the exact reason the market imploded today.
Yeah.
Selling access to raw GPUs has a very low barrier to entry. If you have capital and you have power, you can do it. As long as compute is scarce, CoreWeave and NBIS have immense pricing power. But they are entirely structurally dependent on a tiny handful of massive customers honoring those contracts.
Which brings us to the breaking news from today, July 1st, 2026. This news completely flipped the script on everything we just talked about regarding Meta's vulnerabilities.
Completely flipped it.
Today, Meta's stock surged 10% in a single trading session. That is a $56 jump per share, reclaiming the $619 level. And we have to remember, prior to today's opening bell, Meta was actually down 15% for the year because Wall Street was terrified of that $145 billion Capex black hole.
Yeah, they hated it. The catalyst for that massive reversal was a Bloomberg report stating that Meta is quietly building a public cloud business to rent out its excess AI compute capacity.
Just the rumor of that pivot completely changes the math for a Meta investor. Suddenly, that terrifying Capex black hole looks like an EPS bridge, a concrete pathway to driving future earnings per share.
Exactly.
Morgan Stanley ran the projections this morning. They calculated that if Meta leases out just 250 megawatts of capacity for a single year at a going rate of $40 per watt, it could add roughly $2.97 to Meta's 2028 EPS. That represents an 8% upside to their stock valuation simply from renting out servers that were already sitting in their data centers.
It was a massive win for Meta's shareholders. But the collateral damage for the Neoclouds was brutal, and it was immediate.
Oh, I bet.
CoreWeave's stock plummeted about 11% today, and NBIS dropped over 12%. Consider the dynamic we established just a moment ago. Meta is CoreWeave's single biggest customer. Meta holds 1/3 of CoreWeave's entire $35.2 billion future backlog.
Wow.
And today, with a single leaked report, Meta just signaled that they might become CoreWeave's biggest, most well-funded competitor.
That is corporate ruthlessness at its finest.
Truly.
But if Meta does pivot to renting out compute, can they actually compete with Amazon Web Services or Google Cloud?
If we connect this to the bigger picture, that is the multi-billion-dollar question. Selling raw compute, just handing over the keys to a server is relatively easy. But if Meta decides to move up the value chain and offer hosted, fine-tuned models and developer APIs, kind of similar to AWS Bedrock, that is a profoundly harder business. Meta would have to prove to developers that their proprietary models, like Muse, are actually better than the competition. And based on our research sources, on critical coding benchmarks like Terminal Bench and SWE Bench Verified, which test whether an AI can actually write and verify secure software code rather than just generate text. Meta's models still need to prove themselves against heavyweights like Google's Gemini.
Okay, I have to stop the train here because if you are listening to this, you have to be completely lost on a major contradiction. I know I am.
What's that?
We just established that in March, Google cut Meta's compute allocation because Meta was starving for resources and hogging the servers. Now, in July, Bloomberg reports Meta has so much excess compute that they are launching a cloud business to rent it out. How do we reconcile this? Are they drowning in servers or are they starving for them?
It's a really critical contradiction to resolve. According to a prominent analyst named Serenity in our source notes, the media narrative that Meta has surplus capacity or that they have wildly overbuilt is highly misleading. The reality on the ground is that Meta's compute resources are still incredibly painfully tight. What they are actually doing is selling computing power only when they have transient excess capacity.
Transient excess, let's break that down. Like an Airbnb host who only rents out their apartment on the random Tuesdays when they happen to be out of town on business.
That is a perfect analogy. When Meta trains a massive new iteration of their Llama model, it might take tens of thousands of GPUs running flawlessly for 3 straight weeks. But when that run is done, those servers might sit idle for 4 days while the engineering team evaluates the data before starting the next run. Rather than letting $1 billion worth of hardware sit quietly in the dark, they are building the infrastructure to rent those transient 4-day windows out to other AI labs.
So it isn't a permanent strategic pivot to becoming the next AWS. It is just extreme opportunism to scrape back some costs. And looking at the major Wall Street analyst notes from UBS, Morgan Stanley, and Bernstein, they all agree on this point. This Bloomberg report does not mean the AI industry has hit a wall of overcapacity.
No, not at all.
The supply chain sources show that Meta's self-operated IT capacity is only projected to grow by 3.5 gigawatts in 2027. Compare that to Google, which is expected to add an astonishing 9 gigawatts. Meta is not in a position to flood the market with cheap compute.
Right. This move by Meta is entirely about having a pragmatic fallback plan.
Yeah.
Mark Zuckerberg explicitly noted to investors that if their internal consumer products, like their highly anticipated Meta business agents, don't immediately gain traction and absorb the massive compute they are building, Meta can monetize that idle capacity by leasing it to external AI research labs at heavy premium rates.
Assume those rates are high, right?
Astronomical. For context, Elon Musk's xAI is currently leasing excess capacity to Anthropic for roughly $30 billion per gigawatt annually.
$30 billion, that's absurd. The financial safety net is clearly there. But if this is just a pragmatic fallback plan renting out Tuesday afternoons, why did the broader hardware stocks absolutely tank today?
Context in the financial markets is everything, A note from the JP Morgan trading desk today pointed out that AI hardware stocks were an incredibly crowded trade. Every hedge fund and institutional investor was on the exact same side of the boat, betting heavily that compute would remain scarce forever.
Right.
So when a single Bloomberg headline dropped containing the words Meta and excess compute, it triggered a massive psychological panic and widespread profit-taking. It was a mechanical deleveraging event that exacerbated the sell-off in hardware names today.
So it wasn't even about the reality of the servers.
Exactly. It was driven by trading algorithms and margin calls, almost entirely divorced from the actual long-term supply and demand fundamentals of the industry.
Let's bring this all back down to earth and ask the ultimate question. What does this all mean for you, the listener? Put yourself in the shoes of a startup founder building an AI application right now. On one hand, this $725 billion mega build-out means that raw compute is eventually going to get cheaper and far more abundant.
Eventually, yes.
But the sources give a very stark warning. These hyperscalers are vertically integrating all the way up the stack. They aren't just building the physical data centers, they are writing the core models, they're building the applications, and they control the distribution. It's like they own the land, they grow the crops, they own the grocery store, and they cook your meals.
That's a great way to put it.
So if my startup's only competitive moat is a clever user interface wrapped around an API from Google or Meta, aren't I just renting my business from a giant who is spending $190 billion a year to turn my core product into a free bundled commodity?
You have zeroed in on the existential threat for the entire software application layer. The $725 billion build-out guarantees one thing. The baseline intelligence of the internet is going to skyrocket, and the cost of reasoning will trend towards zero.
Which sounds good for everyone.
It does, but capturing financial value from that intelligence is going to be brutally competitive. If your startup relies entirely on someone else's frontier model to provide your core value, you are highly vulnerable to being obsoleted overnight by a free feature update in Microsoft Office or Google Workspace.
Just wiped out by a Tuesday patch.
Precisely.
Well, to bring this incredible deep dive full circle, we are watching an unprecedented $725 billion AI capital build-out in 2026. The ultimate bottleneck in technology has shifted away from securing NVIDIA chips and landed squarely on the physical limitations of global power grids and liquid cooling physics. We explored how Meta, the lone tech giant without a public cloud, justified spending up to $145 billion internally by using AI to drive massive ad revenue, only to trigger a market earthquake today, with rumors that they might lease out their transient excess server capacity. And we have to remind you, this remains an unconfirmed Bloomberg report.
Right, it's just a rumor.
Meta has not officially validated the strategy. Wall Street will fiercely demand answers for this at their next quarterly earnings call.
Well, they definitely will. And as we wrap up this analysis, I want to leave you with a final thought to mull over.
Go for it.
Earlier, we touched on Mark Zuckerberg's stated belief that AI models must eventually achieve recursive self-improvement if a lab wants to maintain industry leadership. Think about the profound implications of that single phrase.
Okay.
If the future of artificial intelligence requires models that can autonomously consume computing power in order to iteratively write better versions of themselves, and electrical power generation is the ultimate hard physical constraint on planet Earth, then computing power is no longer just a technology service.
Yeah.
We may be crossing the threshold into an era where raw computing power becomes the new global reserve currency, an underlying asset more fundamentally valuable and far harder to secure than cash itself.
And when you start viewing the landscape through that lens, that $725 billion doesn't just look like a corporate checkbook buying servers to run a slightly better ad algorithm. It looks like four massive empires aggressively buying up all the reserves of a brand new global economy long before the rest of the world even realizes the currency has changed.